Coming up on Market to Market. Arid conditions stoke wildfires in California, but the rest of the country could see a break in the weather. The Oracle of Omaha gets a larger stake in wind power as lawmakers call for reforms in renewable energy policy. And locomotives roll through one Canadian town for the first time since 47 people were killed in an oil train derailment. Those stories and market analysis with Darin Newsom next.
This is the Friday, December 20 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. If President Obama's message of hope and change applies to the economy, Christmas may have arrived a few days early. In a revision of previous estimates, the Commerce Department said Friday that the U.S. economy grew at a solid 4.1% annual rate in the third quarter. That's the fastest pace of growth in nearly 2 years. 80% of the expansion was credited to increased consumer spending, but other data also bode well for the economy. Factories increased output in November for the fourth straight month, led by a surge in auto production. Despite higher interest rates, builders broke ground on the most new homes last month in more than 5 years, and the stock market continues to post new record highs. The economic outlook appears to be so bright that the Federal Reserve announced this week that it will begin reducing its $85 billion in monthly bond purchases in January. Even long-range weather forecasts appear to be changing for much of America, but not in the tinderbox formerly known as California.
Residents of California endured another round of wildfires this week. The latest fire tore through dry vegetation in the scenic Big Sur region south of San Francisco.
It's probably the driest year, like many other parts of the state, that we have in the history of Monterey County. Big Sur is historically one of the wettest places in California, and we've had virtually no rain here all year.
This is an unusually late season blaze, but factoring in the weather pattern this season, it is not surprising.
Usually it's wetter by this time of the year, but we're in a dry cycle. We've had very, very little rain. We have some other conditions, such as sudden oak death in this part of the forest. So everything, the warm winds, the warm weather, the dry conditions just lined the pins all up.
The battle to contain the flames is being fought in the air and on the ground by nearly 900 firefighters. About 100 residents have been forced to evacuate from their homes. The fire has burned through more than a square mile in the Los Padres National Forest. Late this week, though, a change in weather patterns brought less wind and a chance of rain. And in many other parts of the country, residents are looking for a change to the early start to winter. An early autumn blizzard over the western plains brought as much as 4 feet of snow to some parts of the Dakotas. Just last week, a frigid cold snap took a bite out of the Great Plains. Temperatures dipped to below zero in Sioux Falls, South Dakota, and the wind chill values fell to 25 to 35 below zero. While winter doesn't officially arrive until Saturday, Duluth, Minnesota has already experienced its 6th largest snowfall in recorded history and recorded its coldest 6-day period since 1958. But a breakdown of the Northern Pacific system, which triggered the early arrival of winter, may be on the way, according to USDA's meteorologist Brad Rippey.
That will lead to the jet stream returning to a more normal position across the United States and lead to warming conditions and a return to above normal temperatures across the southern half of the United States.
But the change comes at a cost. The warmer and drier air will allow the drought over large portions of the West to continue.
So as long as the jet stream continues to bypass both to the north and the south of these areas, unfortunately, it looks like a potential third year of drought may come to fruition here for these areas from California to Texas.
Some locations, however, will likely see regular to above normal precipitation, or a continuation of what they've seen already in the mid-Atlantic.
The greatest likelihood for continuation of stormy conditions will be through this northern tier of the country, stretching from perhaps the northern Rockies, northern Great Plains, on through the Great Lakes region and out through the Northeast.
Lawmakers scurried to wrap up business in Washington this week before heading home for the holidays. but a lengthy to-do list awaits their return in January. The unfinished business includes a languishing farm bill, tax and immigration reforms, and raising the debt ceiling before Uncle Sam maxes out his credit card again in February. With half of the session already in the books, the 113th Congress is on pace to be the least productive in history, and with a November Gallup poll revealing an approval rating of just 9%, it's also the least popular. Nevertheless, lawmakers continue to offer new legislation to put the nation on a path to prosperity. Increasingly, these ideas target energy production. And late last week, a bipartisan group of senators proposed eliminating a key provision of the renewable fuel standard, requiring the majority of U.S. ethanol be made from corn.
Senator Dianne Feinstein, a Democrat from California, and Senator Tom Coburn, a Republican from Oklahoma, introduced legislation last week called the Corn Ethanol Mandate Elimination Act of 2013. The bill would eliminate the corn ethanol mandate from the Renewable Fuel Standard, or RFS. While the oil industry would be released from the mandatory blending of the grain-based fuel additive, the measure would preserve the advanced biofuels portion of the rule. Senator Feinstein says the use of corn to produce fuel is responsible for pushing the cost of food and animal feed higher while damaging the environment. She went on to say that oil companies had hit the so-called blend wall and were unable to mix more ethanol into gasoline without, quote, causing problems for automobiles, boats, and other vehicles. The RFS states that 14.4 billion gallons of ethanol must be produced from corn in 2014. Last year, nearly 44% of America's corn harvest was processed into ethanol to help fulfill a 13.2 billion gallon mandate. The statutes calling for 14.4 billion gallons of ethanol in 2014 are currently under review by the Environmental Protection Agency. But the EPA has proposed cutting next year's mandate by almost 7% to 13.4 billion gallons. Agricultural and processed food producer groups, including the National Chicken Council and the Grocery Manufacturers Association, have signed on in support of the measure. Bob Dineen of the Renewable Fuels Association called the legislation monumentally stupid and referred to the proposed measure as the Oil Monopoly Protection Act of 2013. But ethanol isn't the only renewable fuel facing increased scrutiny. Senator Max Baucus is calling for all clean energy subsidies to receive closer examination. After years of piling various tax breaks and mandates onto energy policy, the chair of the Senate Finance Committee wants the more than 40 different tax incentives to be reduced to just 2. The Montana Democrats' plan draws heavily on several Republican and Democratic strategies, reducing them to one incentive for clean energy and one for clean transportation fuel. Baucus warns that without reform, U.S. taxpayers will be on the hook for $150 billion over the next 10 years. The various incentives include the 21-year-old wind energy tax credit, which is set to expire at the end of the year. Among the electrical power generating companies moving to get construction started before the December 31st deadline is MidAmerican Energy. The Des Moines, Iowa-based company, owned by billionaire Warren Buffett's Berkshire Hathaway, announced it had placed the largest onshore order in the world for approximately $1 billion worth of wind turbines. Iowa already receives 25% of its electricity from the wind, and when the nearly 450 turbines are completed in 2015, that number is expected to grow significantly.
In its annual energy outlook, the government predicted this week that rising domestic production and declining demand will likely push prices lower. According to the Energy Department, domestic oil production over the next few years could return to levels not seen in more than 4 decades. The DOE expects gasoline prices to fall over the same period to just over $3 per gallon. U.S. crude oil production is expected to rise by 800,000 barrels per day through 2016, reaching 9.5 million barrels per day, just 1% below the all-time high set in 1970. The boom in domestic oil production, however, is not without opposition. Some critics say advanced drilling techniques like hydraulic fracturing or fracking pose significant threats to the environment. That concern is echoed by others who oppose plans to build the Keystone XL pipeline to funnel black gold from Canada and North Dakota to Gulf Coast refineries. But it's doubtful anyone has greater reason to criticize America's energy revolution than those who've lost loved ones due to the boom in domestic production. And this week, locomotives rolled through one Canadian town for the first time since 47 people were killed in an oil train derailment. Big Sky Country exudes natural beauty and provides a home to wildlife which can elude other parts of the country. But recent sightings have some small-town Montana residents worried about the potential for man-made disasters.
I've noticed in the last 3 months or so a really large increase in the number of oil tankers that are going through on the railroad.
Memories of the fiery Canadian rail disaster that left 47 dead last summer have residents of Cut Bank and many other Montana communities saying, "Not in my backyard." As rail service resumed in Lac-Mégantic, Quebec this week, a federal bankruptcy judge approved procedures to auction off the Maine-based railroad. The sale would allow rail service to continue through the area, but proceeds would be used to repay creditors and supplement the alleged $25 million in insurance payouts for victims of the tragic derailment. Meanwhile, 100 or more oil tanker cars cruise west daily through the heart of Cut Bank, Montana, on their way from booming oil fields in the northern plains.
The chance of a derailment is very slim, but if you do have a derailment, it's devastating to the community.
Along with the possibility of spills and explosions, officials across the region have expressed their concern regarding the level of response in rural areas should the unthinkable occur.
Are we prepared to handle something like that? And the answer is no.
The increase of oil tankers in Montana can be attributed to the overall rise in rail commerce dedicated to black gold in recent years. An estimated 400,000 carloads of crude moved across the country this year, compared with just 10,000 in 2009. And while the Obama administration remains tight-lipped as to whether it will greenlight the Keystone XL pipeline, those in favor of TransCanada's link to the Gulf of Mexico have long seen their mode of transportation as a better alternative to railroads.
Right now, trains carrying bitumen from the Canadian oil sands are headed to the Gulf Coast. Keystone XL should take many of those barrels off of rails and onto pipelines, which again are the safest method of transporting them.
But railroads are quick to point out that 99.997% of crude oil shipments reach their destination safely when pulled by an iron horse. And should accidents occur, rail officials ensure they have emergency plans in place.
We spend a lot of time and resources in planning, along with prevention.
The federal government claims it has increased rail car inspections while it ponders tougher safety standards for oil cars. But with increased crude on trains, several other domestic commodities that normally ride the rails have run into a bottleneck. Record corn and soybean harvests in the Midwest this year are taxing traditional systems used to move grain to market. Following drought conditions of recent years, crop surpluses that could spawn a return to glory are stuck waiting for a ride. USDA forecasts farm income will soar to a 40-year high in 2013. But the current rail predicament could create a domino effect, which drives up export costs and lowers producer profits. That is, unless other forms of transportation like trucking and river barges are somehow able to fill the void created by the high demand for rail.
Next, the Market-to-Market Report.
Grain prices were mixed this week as the long downward trend in wheat continued, while corn prices contracts posted modest gains. For the week, March wheat lost 15 cents, while the nearby corn contract moved 8 cents higher. Soybeans also rallied as the January contract settled with a gain of 12 cents. Nearby meal prices advanced by $14 per ton. In the softs, cotton traded sideways this week as the March contract declined by 7 cents per hundredweight. In the dairy market, January Class 3 milk rallied more than $1, as did the deferred contract. Over in livestock, February cattle gained just over $1. Nearby feeders declined by a dime, and the February lean hog contract posted a weekly loss of 92 cents. In the financials, the euro gained 6 basis points against the dollar. Crude oil advanced by more than $2 per barrel. COMEX gold declined by $31 per ounce, and the Goldman Sachs Commodity Index gained nearly 15 points to settle at 636.60. Here now to lend us his insight on these and other trends is one of our regular market analysts, Darin Newsom. Darin, welcome back.
Thanks for having me back, Mike.
We set another record in the Dow this week, despite news that the Federal Reserve was going to begin its tapering. Was that priced into the market, do you think, looking at the broad macro picture?
Yeah, you know, you go back to all those numbers and all those reports that you talked about at the very beginning of the program, a lot of green arrows, a lot of bullishness out there right now. And I really think that's what's pushing the Dow at this point. Did there seem to be kind of this, they just kind of pushed this this idea of slowing down the tapering, all this aside, certainly seemed that way this week. Dollar really didn't even react to it that much either. So it was an interesting reaction overall by the financial markets, but yeah, Dow just remains very stout at this point.
All right, now we're not setting any records in the wheat market. we have been on a downward trend. It looks like there's a lot of wheat out there.
Yeah.
What happened this week? Why do we continue to slide?
Yeah, you could basically take the Dow chart, flip it over, and that's what you've got for wheat. There's just no interest in the wheat market right now, and I don't say that to be mean about the wheat market, but we've got plenty of world supplies. A couple weeks ago we had the StatsCan report come out. Last week we had WASDE reports come out, and everything just shows that there's plenty of world production of wheat. There's plenty of supplies out there right now, and there's just no push. There's no real need to really move this market and really get interested in buying this market at a great deal. So without that, it just continues to grind lower.
Now, as we watch the March contract, I mean, technically, how far is the slide going to be, or could be?
The bottom is zero, but I don't think we're going to get there. Now, if we look at all three of the different exchanges, all of them are showing technical signals that market is sharply oversold. That could be enough to spark some buying interest. It's going to be short-lived, and I'm not really anticipating a great deal of commercial support coming rushing back into this market. But at some point, it's going to be so oversold that someone's going to want to cover some short positions, maybe move a little bit of, maybe buy a little bit of wheat here and there. That could be what provides support ultimately.
Now, on the cash side, as we watch this week continue to slide, at what point are feeders going to begin to look at feed wheat versus feeding corn as corn stays steady?
Yeah, I don't think we're going to get there yet because, again, the cash corn price has been drifting down towards $4 as well, national average cash price. So, that spread's stabilized a bit, and I don't really see that coming into play yet unless wheat just continues to fall and corn, for whatever reason, thinks it needs to rally.
Okay. All right. Things to keep an eye on there in the wheat market, and just keep an eye out there.
Right.
All right. Now, as we look at the corn market, we did see a little modest rally on the board this week. What's happening?
Basically nothing. Corn has been in a sideways trend for quite some time. But we're starting to see some headlines of export news being done. So we're keeping this, this fire underneath this idea that we're going to see increased exports in the 13-14 marketing year. Sales are great, but that's not the real story. We've got to start picking up our shipment pace. Right now, we're still on target to be about 50 million bushels light of what USDA is projecting right now. So we're going to have to see our shipment pace actually pick up. Corn technically posted some bullish signals here this week that could indicate just possibly that it's getting ready to move a little bit higher. Now, where is this going to come from? I think the most of the support that's going to come in the corn market could come from short covering. Investors have been short this market for quite some time, most of 2013. If they start covering that position because nobody is selling cash at this point, then I think the corn market could rally for a little while.
And that brings me to my question. We've got a lot of producers out there. They spent the money to dry the corn. They've got it sitting in the bin. It's stored. We're seeing a strong cash price at the Gulf. Are they just not selling at this price?
Exactly. There's not much cash corn moving right now, and so I think there's two camps out there, and it's probably an overgeneralization. There could be one camp that's waiting for the turn of the calendar because they don't need it for the taxes, or two, they're just not going to sell it till it gets to be a better price. We'll see which one happens when we get to the first of 2014. If basis starts to collapse, that means we're starting to see the corn start to fill the pipeline again. If not, and if everyone's still going to sit tight and wait for a better price, that could keep a good floor underneath the basis market, despite all this talk of 14 billion bushel production and everything else. That could keep basis well supported and maybe lead to a little bit of a rally this first quarter of 14.
If we end up in that second camp, if that turns out to be the case, for producers out there with corn sitting in the bin, What targets do you have in mind? Where could corn rally to looking at the charts?
I think it's going to be limited. If you can get, and this is probably going to get some folks, really geared up on this, but if you can get a 30, 40 cent rally, I think that's going to be worth putting in your pocket. Now, we're going to have to go back to old style marketing because of the carry in the future spread. So you're going to have to use all of that to your advantage, plan it out as far as when you want to move it, how long you want to hold it in storage. Don't just sit there open on it. Even if it's rallying, you got to start using this carry in the market to your advantage.
Dust off those ledger books, crack open that Excel, and
exactly.
Start crunching numbers.
Again, old style marketing. It's coming back into fashion.
You bet. Now, is same story true in beans? No. We do continue to have good export news. Bean price staying strong. Where are we going?
I'm still probably more bullish beans than I am anything else. If I look at the overall makeup of the bean market, I still think it's got one of the most bullish structures of any commodity out there right now. We've got an inverted future spread, so there's no need to have a hedge against it. If you're storing it, feed the market a little bit. You feed an inverted market a little bit. But I think this market can still go up. We've got incredible demand right now. Shipments are still very strong. Yes, we didn't see any headlines of sales this week, of new sales this week, but I have a feeling they're probably going on. So in the inverted market, firm basis is all showing us that. So, let the market run. Let it move up a little bit. Let it break free technically here if it can do it. Again, feed a little bit at a time, and we'll see how far it can go.
You say let it break free technically. Yep. What are we looking to break free from?
Right now, if we look at the Jan contract, right around that 1345, it's just been a ceiling on top of this market, and you've got about a 1330 in the March contract. So if we can start to break free of that, and start to clear those hurdles a little bit, then I think the market's going to gain some momentum, and I think it's really going to start to move here to finish off 13 and early in 14.
So it's really going to be the tail end of this month into early first quarter of 14.
Right, because hanging over the soybean market is this incredible crop that's being projected right now in both Brazil and Argentina. Now, the future spreads aren't showing that the traders are overly concerned about it right now. That could change. But we've got this opportunity, say from December through February, for the soybean market to really make a statement, to really take off and run, pull corn with it, and obviously wheat's not going to probably want to go too far, but it might even try to go with it. But I think soybeans are going to have to be the one that does the majority of the work here.
They're going to be the heavy lifters.
I think so.
Well, let's take a look over at livestock. We had the cattle on feed report today. Total inventory down, placements down, and marketing's down. What do we expect Monday morning on the mark?
I think a lot of this has been built in. I think the pre-report estimate was something like 95% or something like that. I think a great deal of it's been built into the market. But if you want to go back to your question about feeding, month after month after month, we're seeing less on feed than we did the year before. Yet USDA is projecting a large increase in feed demand. I just don't see how that works out. So I think it's going to continue to provide support to the cattle. I like the way the Feb-April spread looks in the live cattle market. I think it's trying to turn back around and reestablish its uptrend. The Feb contract is. I think it's going to have a pretty good. I think it's going to have some pretty good, air ahead of it. I think it can rally a little bit.
Now, you like the Feb-April spread. What about the April and after spread? How do things look there for producers marketing this summer?
All of those still look bullish because I think we're still going to be dealing with a tighter supply situation and still a pretty solid demand. So, yes, I'm looking up front here at this Feb-April. Shows me a good deal. It shows me that cash should still be strong. But even the deferred spreads are still looking bullish for further out.
What targets do you see in fat cattle?
The prices obviously just slipped my mind, but where we are in the Feb right now, I think we could tack. It wouldn't surprise me at all to challenge the highs that we've seen recently. I think they're going to get moving again, and I think you've still got plenty of buying to come into that market.
Closed at 133 this week, 133.90. Push 135 possibly.
I think 135 is pretty easy within the next couple weeks on the Feb. If we look out at the deferred contracts, yes, they've got a bit of a discount to them. Maybe not get quite up into the mid 130s, but I still think they can show quite a bit of strength.
All right. Now, as we take a look at feeder cattle, we're seeing corn stay strong. We lost about a dime feeder cattle over the week. Where's that market headed?
I think feeder cattle is going to stay relatively stable for right now. Yes, corn could come up, but again, nobody's really anticipating a huge rally in the corn market. More of a short covering thing than anything else. And so if feeder cattle start to consolidate, I think longer term, they've still got enough support to go higher. And if the live cattle market's going up, feeders might try to ride that coattail for a little while. So I still like the feeder cattle market, not as much as the live at this point, because there is that idea that if corn goes up, it's going to limit the rally of potential in the feeders.
Now, you spend a lot of time talking to farmers at conventions and seminars and so forth. Are you hearing a lot of folks planning or intending to retain heifers and keep them out of the feeder cattle market to grow their herds?
I've heard some of that because I'm hearing that there's going to be this big demand coming back to rebuild the herd, and the only way to do that is obviously to have the stock available to do it. So I think there is some of that's going to be going on, and with the producers that I've been talking to, recently concluded DTM Progressive Farmer Ag Summit, a lot of talk about it up there. That same sort of situation playing out here over the next year and a half.
But probably not enough to put any major support into the feeder cattle market.
No, I don't think so at this point. I think there's still going to be enough coming along to really not say we're in an extremely tight supply situation on feeder cattle. But demand is going to get stronger for feeder cattle as we work our way through 2014, and so I think that's going to help pull the whole market higher.
All right, well, let's take a look at the hog market. We've been hovering there a little bit above 86, 87 for the past couple weeks. Where is that market headed? To compare it to cattle, which has a very bullish Feb-April spread, the Feb-April spread in hogs have been going the other direction. It's been trending down. The Feb's losing ground to the April, so the cash market's softening a little bit. I would not be surprised to see the Feb contract continue to work lower. I know it's testing some support around the 86, 86.5 area. Would not surprise me to see the Feb possibly dip down into the mid-84s. It just looks like it wants to grind a little bit lower in here. Now, that having been said, support could come from the other livestock markets, but fundamentally, on its own, there's really no reason right now for the hogs to move higher. Long term, I think they're still bullish. Short term, not so much. Now, as we look at next summer, we know June hogs pushing 100. Time to make a sale at 100?
I'm never going to tell anyone that it's not a good idea to sell if it's profitable, and if $100 hogs are profitable, in the summer, certainly take a look at it. I think the market could move a little bit higher. I think we'll be back into more of an upswing by the time we get into the spring and summer time frame. So I think there's some potential for the market, but by all means, lock in the profits.
All right. Thank you so much, Darin. Thanks for being with us this week. That wraps up this edition of Market to Market. But Darin and I will continue our discussion and answer some of your questions in our Market Plus segment on our website. You'll also find audio podcasts and streaming video of our program, as well as links to our Twitter feed and Facebook account exclusively at the Market to Market website. And be sure to join us next week when we'll look back on 2013 and examine the impact of key developments in rural America. Until then, thanks for watching. I'm Mike Pearson. Happy holidays.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.